Hi, good evening, everybody. Hi, Wee Kuang, welcome.
Hi, Alvin.
Can you hear me?
Yep, I can hear you fine.
All right, great. Okay, welcome everybody. Welcome to our Tuesday segment. Tonight is Singapore Tuesday, where we feature anything SGX related, or we cover stocks that are SGX related. Today we have a very special guest, Tay Wee Kuang. Right, he's actually from Phillip Securities, all the way from Singapore, and he will be talking about the banking segment in SGX. I'm sure everyone is quite interested with the banking segment. And I believe tonight's segment will also be a little bit educational as well. For those of you who don't understand banking stocks, or you're not sure how to analyze it, we have Wee Kuang here to actually help explain to us, right, some of the nuances of the three major listed banks on the SGX. For those of you who are driving back from the office, or you're just tuning in, welcome to the show. If you can hear me loud and clear, if you can just comment in the section below to say that you can hear us loud and clear, that would be great. Today's COVID cases, big number jump, right? In Malaysia, I think I think we're at over 600 now. Okay, 683, I think, to be precise. Big jump from yesterday, more than double. So I hope you guys are following the SOPs, wearing your face mask, keeping your hands clean, and staying safe, right? So if you guys can hear me, can just put in the comment below that you guys loud and clear. Okay. Yeah, great, loud and clear. Okay, Weekend, you want to sort of kind of introduce yourself, and then we can get started on the presentation that you prepared for us.
All right, thank you, Alvin. Okay, actually, nothing much to introduce about myself. Basically, I'm a research analyst from Phillip Securities Research in Singapore. Previously, I actually joined this role just this year, but previously I was actually like a equity dealer. I'm on like a stockbroker for Phillip as well. So it's kind of also a very short time in the research role, but of course I'm willing to share whatever I have with you guys today. Yeah, about the banking
Great,
sector. Yep.
awesome. So if your slides ready for me to share? Your slides are good, right? I'll just share it now. Okay.
Yep.
Now for those of you who want access to these slides, you actually can get them. The number to WhatsApp us is at 603-8408-2070. I will post it in the comment section below, where you can actually download some of these slides after the show. All right. Okay, cool. So I've kind of briefed Weekend what to expect, right, from this segment. So he's gonna do his presentation first, and then we're gonna have a Q&A segment at the end. So make sure you stay till the end. You can have a Q&A segment. Also, I've gone through the slides. They are very good kind of introduction if you guys are interested in how to actually analyze some of these banking stocks, right? Of course, they're very different from what we used to, which is manufacturing or other types of companies. Okay, we can over to you.
Thank you, Alvin. All right. So good evening, everyone. Hope you've had your dinner, or if you're on the way, you can have your dinner as well while listening to me. So today, actually, my job here is just to let you understand a little bit more about the Singapore banking sector. But of course, I can't say too much afterward. Otherwise, I would not have a job anymore. So generally, what I will do is I'll be teaching about some of the generally how people look at the banking sector, what are some of the terms that people use, and then we will slowly go into more details, and then zoom in into what is the Singapore banking sector like, right? So yeah, okay, just a disclaimer, everything here is for educational purposes. Not really trying to sell or anything. It's really up to your own investment decisions ultimately, depending whether you feel that it is according to your investment needs as well, right? Okay, So just an industry overview of the banking sector in Singapore. Of course, we are regulated by our Monetary Authority of Singapore. And then, of course, as we know, in Singapore, we have three listed banks. They are the three domestic players, DBS, OCBC, and UOB. And together, they are like our household names, and they are the largest three stocks in the SGX itself. So it plays a very important part in our stock market as well. So if you're looking at the STI, definitely you will have to gain, if you want to gain exposure into the Singapore market, you will unknowingly through STI, you will definitely get a part of your exposure into the banks itself. So it's always helpful to know a bit about the banking sector in Singapore. It makes up about 35% of the index. Yep, so that's quite significant considering we have 30 stocks in the index. Then, apart from the three domestic players, we do have other, they call it the domestically systemically important banks. Okay, it's a mouthful. And generally, DBS, OCBC, and UOB, together with Maybank, Citibank, Standard Chartered, and HSBC itself, they make up, they are considered very important to our financial system in Singapore. And so they are required to fulfill a higher regulatory requirements when operating in Singapore, because maybe like if and in any case, if there's any form of default on anything, they might cause a huge impact on our economy as well. And then, apart from these seven banks, there are our DSIBs. We also have banks operating other divisions, such as your wholesale banks, your investment banks, so something like your European banks and the smaller banks from other countries that are in Singapore as well. So it's quite a competitive marketplace. Yep. And next, so just a brief breakdown of how the banking industry works. Generally, we look at, of course, what people like to look at is the revenue breakdown, right? Where does the banking sector actually get their income from? So in terms of income, generally we separate it into two classes. So you have your interest income. So generally it's just from lending money and borrowing money. That's your interest income. And under your non-interest income, you actually have fees and commission, as well as other non-interest income. So if you look at the breakdown of the bank's revenue for the second quarter in 2020, I actually classified them according to their colors. So that you can see that majority, so the three banks, bulk of their income stream is actually from interest income itself. So more than half of it is from interest. So it really shows that the bulk of the business actually it comes from lending money, right? And so to move into understanding these different income streams, first of all, we start with interest income, right? So like I mentioned from the previous slide as well, the bulk of the income, more than 50% across the three banks. Then generally what people look out for when we talk about interest income is this thing called the net interest margin. So generally, it's just a formula. It makes things a little bit confusing, but it's just your interest received in the quarter minus your interest paid out divided by your interest earning assets. So of course, I can just tell you like that and then just leave it as that. But right, how do we understand more about this net interest income margin, which constitutes the net interest income, right? So we look at the first part, interest received. So when the banks loan out their money, they actually receive a payment in the form of interest, and this can go into the individual segments. So the type of loans that you have, so from your business loans to which have separate industry exposure, such as aviation, oil and gas, financial institutions, and etc. To your consumer loans, which is your like your credit card loans, car loans, housing loans, etc. So all the different interest rates play a part into contributing to the interest received by a bank. Then when we look at interest paid out, so this is what the banks actually, the interest on the deposits that you place with the banks. So as their customer, actually, when you put your money with the banks, to them, it is a liability because they need to pay out interest rates to you. Although we know that in the current environment, the interest that you actually place with the banks is very low, right? Probably 0.0 something percent. I'm not sure if it's the same for Malaysia, but that's how it is for Singapore. And
Yeah.
when we talk about the types of deposits that we have, Generally, people always talk about the CASA, which is your current accounts, your saving accounts, and then you also have the other side of deposits, which is your fixed deposits. So, what does CASA? Okay, so generally deposits is separated into current savings and fixed deposit, three types of deposits. And for why people like to look at talk about CASA ratio, right, is because CASA is a most kind of fluid kind of funding for the banks. So generally, we know that fixed deposits, because they lock you in for a fixed period of time, they need to pay you a higher interest rate. But then, if you're actually putting into just a normal current account or savings account, the interest rate on that account is close to zero. So basically, for the banks itself, there is almost no cost to them to actually increase the CASA ratio. If more people put money into the banks for them, the more funds that they can actually use it to loan out and earn a larger spread. And then when we talk about the interest earning assets, again, it is your loans that we talk about in the interest received as well. So apart from loans, you can have other things such as investment holdings that actually generate interest for the bank itself. So you can have things like bonds that is also included into your interest earning assets. Yep.
We can just curious, I'm just trying to draw similarities to say Singapore and Malaysia.
Mhm.
I know right now in Malaysia our fixed deposit rates are something like 1.75 or maybe 1.8%. Of course, our interest rates have been revised 5 times, throughout this year. Just
Yep.
to give us an idea, what kind of fixed deposit rates are we looking at? If you're saying you're in Singapore, what kind of range are we looking at?
Unfortunately, in Singapore, I think it's even lower. If I'm not wrong, if 1 year interest rates, if you put a fixed deposit, depending on the quantum, of course, so the more amount that you might be qualifying for a higher interest rate.
Yeah.
But for typical interest rate, I think currently for 1 year is about 1%. You can take a look. Yeah, just about 1%.
Okay. All right.
Yeah,
That's not too bad because your borrowing rates are kind of it has to be higher than your interest rate, but your borrowing rates are also lower, right? So the banks basically earn the spread
correct.
between what they pay us as consumers in fixed deposit versus what they lend it out at.
Yes, that's right. That's right. So a lot of it is based on pricing. Of course, they need to be competitive within the market, lah. Yeah.
Sure.
Okay, so just moving on, I'll talk about some of the determinants of net interest margins, right? So we always like to talk about, oh, net interest margins is high or low because the interest rate currently now is high or low. So why is that the case? So I was talking with Alvin about how the interest rates fluctuate between your borrowing and your lending. Basically, it moves kind of in tandem, right? You can't possibly ask people to deposit money with you at a low rate and then you lend out at a very high rate because you have no clients want to lend from you, you to want to borrow from you anymore. Yep. So interest rates actually have an impact on your asset yield. So for the banks itself, the assets is the loan. So how much they can loan out a particular, how much they can earn from their loans, and the cost of deposits, which is like I said, the cost of your funds on your deposits that you put with the banks itself. So for me personally, I like to take a look at the banking industry locally, um, by benchmarking it to the interest rate. So in Singapore, we have the SIBOR, so the interbank offer rate, as well as the SOR, which is the swap offer rate. Uh, these two rates are generally what the industry uses when the banks actually loan out to customers. And if we look at that, the red color line indicates what is the average NIM when you peg it across the same timeline for the interest rates itself. And we can see generally it's quite correlated. Just that currently we see that the red line, which is the average net interest margins, have actually dipped below the blue lines, which is your benchmark rates. Um, so this is something that I think because of COVID-19, we saw that it was a result of COVID-19. So at the start, when COVID-19 happened, a lot of people were very scared that the liquidity in the system um, was not high enough. So a lot of the banks started to build up their liquidity, like their deposits, or they borrow from the central bank a lot of money. And what happened is that because they borrow from the central bank, the cost of deposits became higher and their asset base became larger. So it pushed down their net interest margins as a whole. So we are expecting to see some of these net interest margins start to improve a little bit moving forward. Then, of course,
So
the
you
second
think
thing,
that their margins were squeezed because they took on uh, more, how would I say, more liabilities in a sense. They had to borrow more money, I guess, to boost up their balance sheet in case of a liquidity crunch, and that kind of brought their costs up because most of these banks are mostly, in terms of revenue, their interest income is the largest segment of their revenue, right?
correct. I think because what happened was that at the onset, right, when the countries and the governments, they didn't know what was the impact on the economy yet. They were very afraid that a lot of businesses needed additional loans. So they
Yeah.
were encouraging the banks to stock up on their funds so that if the economy needs the funds, they can actually lend it out to the customers if required.
So it's like buying inventory
Kind of,
for
yes. You can say it that
just
way.
to prepare for when there is demand, right? Surge in demand for Singapore dollars, right?
Correct. That's
Yeah.
right. And unfortunately, that was not really the case. So what happened was that apart from like I was saying, apart from the interest rates, we also see that the loans and deposits growth actually matter to the net interest margins as well, right? Because what we see if on the right hand side of the table is actually like the loans growth in Singapore. So right now they are nearing about 0%. So it's quite a sad number. So year on year, our loans kind of shrank, and it's because I think when we entered this, everybody just started saving money. They didn't like companies were not investing
Yeah.
uh yeah, into infrastructure and everything, and consumers also were like afraid, or what if they lose their jobs, they don't want to spend on credit cards, housing loans can just cut down. So they were all trying to pay back the loans instead of trying to take on more loans because of the uncertainty brought about by COVID-19
COVID
as
19. So, but would you say that this loans growth is typically quite cyclical in nature? That at some point loans growth will have to kind of move back towards, or do you think this is going to be like a constant decline? Because COVID 19 is very sentiment driven, right?
correct.
Yeah.
Personally, I feel that we definitely for the banks to grow, we need the loans growth to be positive. And unfortunately, generally it is not very cyclical, but what we are experiencing in Singapore is that business loans have been actually quite healthy. Just that the current, maybe the past 3 months, it has actually seen a downturn. As for consumer loans, it has been sluggish for quite a long time. But currently we do see a bit of uptick. So you see the red line, right? It started to go upwards. That's because I think people started spending more. I think maybe locked up too long previously during the circuit breaker period. So they started spending more on their credit cards. But again, big ticket items like traveling. So people can't spend on travel anymore, right? So it's still going to be depressed for a while to go. Lah.
I'm just curious, what's the typical interest rate for credit cards in Singapore?
Oh, wow, credit cards. I'm not very, I'm not very certain, but I think it was about 10, 10+%. I think, if I'm not
10%.
wrong. Yeah, it's quite a high.
18% here in Malaysia.
I think it might be comparable to Singapore's.
Okay.
Yeah.
Okay.
Mm. All right. Okay. So I'll move on. Talk about the next part of our revenue, which is your fees and commission income. Right. Fees and commission income generally is just a whole list of things. You have brokerage, you have your investment banking fees, transaction services, loan related, cards, wealth management. A lot of these are transactions related, lah, generally. And then the third part, which is your other non-interest income, you have trading income, which is so the banks themselves, they do their own trading and they have some gains and losses from that. And then they have net gains from investment securities as well. And you have dividend and rental income, some life and general insurance, particularly for OCBC, because they have a large stake in Great Eastern Holdings in Singapore, which is an insurance company. Yep. But generally, for these two, we can't really, we aren't really able to have visibility on how this will perform in a particular quarter. We can only usually peg it to how the market sentiments are like. Is it positive or is it negative, right? So, for example, during the COVID-19 circuit breaker period in Singapore itself, we do see fees and commission kind of offset each other. So things like wealth management. So wealth management, usually you have your relationship managers from the banks go and sell to you on the streets or at the branches. And so with all the lockdown, there's no interactions, human to human interaction anymore. So wealth management fees kind of came down. But then again, you see that the stock market fell a lot, and then a lot of interest from the retail investors in the stock market, and the brokerage fee kind of offset and it went up instead. And then, however, for other non-interest income, so like trading income, because of how drastically the stock market fell, I think a lot of them were actually realizing losses in the market. So we do see that non-interest income actually fell during the second quarter itself. Yeah. So generally, we peg it to a kind of like a macroeconomic condition for this kind of income stream. Can't really like forecast and say, we think how much it's going to improve by, but we can just give a slight guidance whether it will be positive or negative in this area.
So I guess for the interest income, it's quite fairly stable in a sense, quite stable income. Would you say that?
Yes, definitely it is. Interest income is actually quite stable. Unfortunately, right, I forgot to mention, for the interest income, we do see there's a bit of a lag time because we know that, for example, loans, some of the loans are the loans turnover rate is very fast. So businesses who do a lot of businesses, they kind of turn over their loans quite fast, so they are able to peg it very closely to the SIBOR and the SOR interest rates. However, for example, like your fixed income, like fixed deposits, you need to wait until your fixed deposits actually expire, like 1 year later, then you can renew your new fixed deposit rate. So a lot of the banks are kind of stuck when it comes to controlling their funds, the cost of their funds. So for example, within this year, there were 5 interest rate drops. They can't suddenly say, all those who place a fixed deposit before these 5 interest rate cuts, let me just drop your interest rates now, because they are not allowed to do so. So they are stuck with an amount of fixed deposits that will be on a higher interest rate for a while before these expire, and then they can renew it at a lower interest rate.
Okay. So you were talking about, I guess for the viewers who are not familiar, Great Eastern is actually also owned by OCBC. So would this mean that for an investor to get access to, say, Great Eastern, they would buy OCBC? Would that give them exposure into Great Eastern's earnings, or is that a complete separate entity?
Right. Actually, Great Eastern is also listed, but I think 85% of the company is actually owned by OCBC. So if you buy OCBC, you do have exposure to Great Eastern as well.
Right. Okay.
Okay, so let us move on. So so that's all for the revenue part, and we try to look at the expenses. So expenses is also quite simplistic. Basically, what it's the same expenses that any other company would have lah. So generally, you have your staff costs and you have your revenue related costs. So so generally things like your relationship managers, they might be compensated on a commission based basis. So it's kind of pegged to their sales lah, right?
Sure.
And then you have your occupancy related costs, IT related costs, and others. So actually there isn't anything to look at lah. Generally, it's just part of their operations. So we don't really go into detail and say like, we think that staff costs will increase 5%, 10%, revenue will drop by 3%. We don't really go into that detail. So a very generic view of how the operating efficiency of a bank, we just look at the cost to income ratio. Yeah.
Right.
So the cost to income ratio is actually derived by taking your operating income divided by your operating expenses. Pardon that typo. Divided by your total income. So taking all the expenses that was listed down, you just divide it by your total income. So in Singapore, I think most of the banks are aiming towards a cost to income ratio of about 40%. And I think currently it is hovering about 45 to 50%. Yeah, so that's a rough gauge of how it is. But basically, like I said, it's a fancy name for efficiency for a normal company. Yeah.
Oh, it's a margin, right? Would you say it's a margin? In a way,
Yes,
it's a
kind of
percentage margin. Yeah.
operating margins. Yeah.
So
So
what do you mean by, sorry, what do you mean by occupancy related costs? Do you mean like the bank branches that they own and things like that?
yep, that might be. So something like because they own the branches, they need to pay the rents and etc. So these are all your occupancy related costs.
Okay, okay,
Mm,
okay. So cost to income ratio is essentially what we call operating margin, I guess.
correct.
Like the profit margin, for example, right?
Yes, that's right.
Yeah. Okay.
So if we take a look at how a typical income statement will look like in brief for a bank, you can see that by now, right, I would have covered almost all of it, lah. Right? So that's how the income statement usually looks like. And unfortunately, it is not as simplistic as this. I wish it was as simplistic as this. So we see that there's actually three more lines, or actually just one more line, which is called the allowances for credit and other losses. And then you see your start seeing your acronyms like ECL, Stage 3, SP, GP, before you reach your profit before tax. So uh, I'll try to go through a little bit about the credit cost. Okay. So, but what we do know is that what we have covered so far generally is what people refer to as operational performance of a bank itself. So they have this profit before allowances. Yeah. So this is kind of like your operating profit. Yeah.
Okay. So basically, ECL stands for expected credit loss, right?
Correct.
And I guess maybe just for some of the viewers out there, it's basically kind of the interest that you owe. What we talk about a profit before allowance is whatever interest income that you have earned minus your expenses for the year. That's your profit. But that's assuming that all your loans get paid and there are no allowances for bad debt. Uh, so to speak, right? So this would actually include as part of the cost of running a bank is how many of your borrowers may actually default, right? Just to kind of put in perspective.
Yes, that's right. So
Yeah.
yeah, there's a big part of managing a bank's operations as well. Okay. Yep. So now we try to understand what does these allowances kind of mean. So like Alvin was saying, so why do they actually provide for allowances? Because they are assets. So in terms of their loans, it can become non-performing. So in a sense, like you loan out some money and people suddenly just tell you that, oh, I can't pay off anymore. And what happens is that you need to remove it from your books, from your assets, because they are not generating any income for you anymore. And in other than non-performing loans under non-performing assets, you have your others such as your debt security. So if you are holding a bond, the bank is holding a bond and suddenly a bond defaults, so that is part of these others, and there are other contingent liabilities as well. But usually, the bigger bulk of non-performing assets consist of the non-performing loans. Yeah. So just something to think about is that would you prefer to prefer to cater for a non-performing asset only after the person tells you that, oh, I can't pay for it. Yeah, so this is very important because if we take a look at the bank operations, and we know that they're earning generally based off interest, and interest rates are so low. So in terms of the loan book compared to the interest income, your interest income as a proportion to your loan book is probably like hundreds of times, yeah, in a so your loan book compared to your interest income that you earn is actually much larger in the billions. So um, if a big part of it suddenly turn negative or default, it will be a very big it will actually be a very big worry for the bank itself. So you think of the global financial crisis. When we talk about the global financial crisis, what happened was that there was a sudden big wave of bad debt coming from the housing loans, and then all of a sudden the banks go into a liquidity crunch because they can't collect their money anymore, right? So what happened at the onset of the global financial crisis in 2008 and 2009 was that the regulators around the world and the banks came together and they came up with this expected credit loss model, yep, to try to cater for these loans, bad loans, even before they are incurred, right? So when we look at the ECL model, it is actually moving from an incurred, which is a retrospective kind of viewing your allowances, to the prospective model. So they are trying to forecast how much of their loans are going to turn bad this year. So this allows banks more flexibility and more stability as well, because if they have some data that shows that, oh, there's a high likelihood that part of my loan book is going to default while I am in peacetime, so while everything is still looking healthy and all, I can take some part of it out of my earnings first, so that when it actually happens, I would have provided sufficiently for it, and I wouldn't have an impact in my future earnings when things turn bad.
So basically, you're saying that before a borrower cannot pay or tells you he cannot pay, you are preempting that he already cannot pay or he or she cannot pay, and you're writing down the loan as a loss. Am I right?
Yes, that's right.
Okay. Okay.
So under the ECL model, loan impairment can take form in 3 stages. So you have the stage 1, stage 2, and stage 3. And stage 1 and 2 is what people to refer to as the general provision, which is actually on non-impaired loans. So actually, for these loans, they are not, they don't look likely to default yet. Whereas for your stage 3 is for specific provision, which is on impaired loan. So you kind of already have a certainty tagged to a particular account, a loan account, that, oh, this person is going to default. So if I were to draw illustration, GP is actually largely contributed by a quantitative model from macroeconomic factors. So for example, I have $1 billion worth of loan in my account, and this year everything is looking fine. Everybody is paying me my interest. I don't really think that they will default. However, I know that maybe 1 year down the road or 2 years down the road, I'm expecting a GDP to drop by 5%. So I think that, oh, because of a macroeconomic condition or a macroeconomic event, my current healthy loans might turn bad. So I just put in into my quantitative model and let it help me calculate a black box, and then come up with a number and say, okay, this is how much provision I want to put into the reserves, so that I can anticipate the future losses that I might have.
I'm just curious. So when we talk about stage 1, and so maybe just to catch up, because in Malaysia, we got how do I say, a 6-month moratorium, which means that all the ones on loans didn't actually have to pay until this month. This month was the first month that everyone had to start repaying their loans. Of course, the banks that kind of came in. They reported their June numbers because there was no default yet, because we were still on the moratorium. But a lot of them actually had already put in ECL stage 1, stage 2, right? Typical stage 2 being a more kind of a bigger number, right? But what is the difference between, maybe for the viewers, stage 1 and stage 2?
Actually, for stage 1 and stage 2, usually they lump it together. So on the line item that you see, right, if I were to go back a little,
Yeah.
usually you see the GPs, they just add it, they lump it together. I'm not sure if Malaysia does it by segregating them.
Yeah.
But if you want to go into the accounting details of it, stage 1, you have to only take into so basically, if the entire amount is going to, you expect it to default, for stage 1, in terms of stage 1, you only cater for 12 months loss in income.
Yeah.
Yeah. But then
Okay.
for stage 2, you'll take the entire lifetime loss of income for the
Stage
loan.
2 is you take the. So let's say, if, for example, if your housing loan outstanding was, let's say, 100,000, and you expect this guy not to be able to pay, so which means you write off the whole 100,000.
Yes.
Okay. Okay.
So that's the nitty-gritty kind of detail that
Mm.
but it's generally people just lump it all together because
Okay.
these are not likely to actually you can't pinpoint a specific person that is going to default in your loan book. Yeah, right.
Yeah,
Because it's a
sure.
general provision.
Yeah.
So, and the GP gives the banks a little bit more a little bit more flexibility in a sense that because it is generally macroeconomic by nature, they can actually top up as and when they want. They feel that even if my model tells me that I need to put in 1 million or $2 million into my GP, if I think that it is not enough, as a management of the company or the bank, I can actually say, I think that the model is providing too little because I foresee a worse economy. Let me add in more into the GP first, even though it doesn't show up in the model right now. Yep. And for specific provisions, it'll be tied to specific accounts that is in your already considered under your non-performing loan. So, for example, in I think March, April, in Singapore, we have a huge case of the oil trader going bankrupt, and
Mm.
yeah, so that is when you see that there was a lot of articles saying like, oh, this bank is gonna have how much exposure to this because they are definitely going to write off the entire amount of their
Yeah.
income, yeah, in the first quarter. So we saw like 200 to $300 million for written off just off the table like that in the first quarter.
Yeah, we have a question right now. Actually, it's regarding Hin Leong, and then you kind of brought it up. I mean, since you're kind of talking about it, how badly were the banks affected by the default in Hin Leong? I mean, we understand uh, our Malaysian banks who are what you call S systemic domestically. I can't remember
Then,
the
yeah,
words.
important bank, yeah, the important banks.
Very important banks, right? I think some there were some Malaysian banks in there, right? So how big was the Hin Leong impact, right? I think for the viewers who don't know about Hin Leong, you can kind of Google it, but basically it was commodities or oil trader that went bust, right? And there were a lot of loans outstanding with the banks as well.
Yep. So for the local banks itself, the most impacted were DBS and OCBC. Generally, they just have a larger exposure to the oil and gas industry. Um, and if we were to put it in perspective, if you take a look at their revenue for that quarter, if I'm not wrong, DBS managed to cross $1 billion, but the losses that they had to take in for Hin Leong itself was about $300 million. So that's 30% just shaved off the earnings. Yeah,
Okay.
yeah. So I think OCBC was roughly the same amount as well.
What about the other non-Singapore banks? What was that kind of the total impact to the whole industry? Do you know? I mean, for Hin Leong.
I can't really exactly remember the number, but it's definitely in billions of dollars. That I think most of it went to, if I'm not wrong, Citibank. I'm not sure. I can't. Yeah, I can't remember off my head. Sorry about that.
Okay.
Yeah.
All right.
Yeah. So I think at that point in time, people were also very curious, like how can you are only earning about $1 billion in a quarter and you suddenly write off 300 million because bulk of your 1 million your $1 billion in your income is in interest, so it's a percentage of your total loan book. But when you write off the entire loan book of a particular account, so it's a very huge amount that you're writing off suddenly.
Yeah.
So we want to know what happens to allowances, right? So we say that it's a preemptive kind of inclusion into the reserves. Um, so it's actually passed through our income statement as a loss or as an expense if you want to take a look at it that way. Um, then basically the banks actually have this accumulated allowances that is kind of like their reserves when things go bad. And we kind of record it as a credit cost. So you will probably hear this term a lot for the banks in terms of credit cost. Basically, it is allowances divided by the total allowances that was given within a particular period divided by your average loans during that period times 100%. And usually this is presented in a per annum kind of basis. So what do I mean by this? Just to take a look at, I think this is for UOB. I took out some numbers just from their recent quarters results. If you take a look
Yeah.
on the right side, the top table, we see that for the quarter itself, for the first half of financial year 2020, they actually provided for $682 million worth in credit of allowances lah, in total. And
Yep.
then for customer loans between December to June, because for a half year period, it actually kind of grew from $268 billion to $280 billion. So you can see this is the magnitude of a bank's loan book lah. It's in billions of dollars, hundreds of billions of dollars, right?
Yeah.
Um, and if you were to calculate the credit cost, which is given on the screen right now, if you do a quick calculation, uh, you take the 682 in total allowances for the first half, and then you divide it by the average between the two between December and June, and you multiply by 100%. What you get is actually 24.8 basis points. Yeah, and what if you, because this is for half a year, so basically you just multiply it by two, and then you
Yeah.
get roughly about 50 basis points. And the company itself, they reported 52 basis points. So this is a rough calculation because, of course, the average loan that they manage in their system over the half of year fluctuates. But so next time when you hear someone tell you like, oh, they are expecting an X amount of credit cost for a particular period of time, you can kind of calculate backwards and find how much allowances are they expecting of the banks itself. Yeah.
So is there like a good number or a bad number? I mean, what is kind of, I guess, for COVID that's going to be kicking in for some of the banks ending this year. What are average numbers, and what are COVID-19 numbers?
Yeah. So what the Singapore banks have done, they provided a guidance of the credit cost over the next 2 years because they feel that the full impact of it will come within these 2 years. The hardest hit will be during these 2 years. And they guided for 100, about 100 to 120 basis points across 2 years, which is to say if you analyze it, it's about 50 to 60 basis points. So you will see the Singapore banks reporting credit cost between 50 to 60 basis points every quarter. Yeah. So that's roughly what we are looking at as well.
That is probably. I mean, I mean, personally, a lot of banks are typically quite conservative in nature, and maybe tend to sometimes over provision. Not excluding, when I say banks, not excluding central banks as well.
Yeah.
Do you think some of these numbers could be kind of over, kind of exaggerated? I mean, what are normal numbers looking at 20 plus points, and you're saying the credit cost would have by MAS is double of that, right?
Yeah. So right now, okay, on a typical year, I think credit cost usually 20 basis points. I think it's quite
20.
a normal level. And now they're looking at about 50 to 60 basis points. Yeah. So
Yeah.
some banks are able to keep it below 20. It really depends on what is the loan quality, whether there's any what's the credit cycle like, whether there are any particular industries being hit by major events like the oil and gas industry a few years back,
Yeah.
or there are certain industries hit particularly hard that might cause some. But because generally it is like an industry-wide thing, so you are able to get some news beforehand. Yeah, you can preempt a little bit of it.
I see.
Yeah. So of course, when we take a look at allowances, we always also want to know like what is the safety net to loans. It's so bad, right? Like if every time I'm just gonna add it into my allowances, my reserves is just gonna keep growing and growing. And when do I actually use it? And what happens if I never ever use it? Yeah. So we know that for loans itself, your loans may be secured. So some of the banks, they like to come out and say, oh, we are actually providing this amount for credit costs, but a lot of our loans are actually collateralized. So when you actually go to a bank, you want to borrow money, they won't just say, oh, you want to borrow $1 million, I'll just give it to you. They will ask you for something of a particular value to them as well. So for example, like your housing, they will collateralize your house. And then if you default on your loan, they will just take your house. Yeah. So and then that's why they have a metric called the loss allowance coverage ratio. Yeah. So when we try to calculate the coverage ratio, again, we look at some of the banks. We can see under a section they will always have this total allowances plus RLAR divided by NPA. So before we actually get into calculation, we want to know what is this RLAR that is within the formula. So actually it refers to a regulatory loss allowance reserve. So it is actually to top up this total reserve that you have. So generally your reserves that you have in to combat a case of bad debt is that you have your SP plus your GP. Then if your SP and GP does not meet the minimum requirement under the regulation, you need to top it up through this RLAR. And for Singapore banks itself, they need to hit a minimum 1% of their total loan book. So if I have $1 billion, I need to at least have $10 million in my reserves in a form of allowances, right? And for example, my SP plus my GP only adds up to $5 million. So I'm having a shortfall of $5 million. I need to top it up. But the unique thing about this topping up of the RLAR is that you do not need to do it through your profit and loss. It doesn't go through your income statement. It actually goes through your retained profits. So it goes through your balance sheet and it doesn't reflect that badly on your income statement. So, and the next question you might come to your mind is, so why not just always take it out from my balance sheet rather than just directly taking it through your expense? It is all good in during healthy times, but if you think about it, when the loans actually start defaulting, you have to charge it through your even if you take it out of your balance sheet, you need to charge it as a loss through your income statement as well. So not many banks, especially in this particular period in time, will add to their RLAR. Instead, they will try to pass it through their income statement just to be more prudent during this volatile period.
Okay, so which means that so basically total allowances plus RLAR over your NPA needs to be higher than 100%. Is that right?
No, you don't actually need to be above 100%. I think generally, of course, the higher the better, but it is just need. I think if I'm not wrong, at least you need to maintain an 80%. If I'm not wrong.
Okay, so what does 106% mean in this case?
Okay, so if we take a look at the calculations, so we take a look at the other two boxes. So the total allowances for, I think this is UOB. Yeah, I think it might be UOB. Yeah. So they have total allowances in their reserves of about $6.7 billion, and their total non-performing assets is actually $6.3 billion. So in a sense, the amount of allowances they have, assuming their non-performing assets all suddenly just like, write it off their books, they can actually have enough allowances to cover entirely their losses that they will have.
Okay, right. Okay.
Yeah. And then because it is secured, some of them might actually look at the unsecured loan coverage ratio, which is the following line, the 199% that you see on screen. So instead of using the total non-performing assets, you remove the secured loans out because you know that there's some salvage value behind it, and you just use it as a unsecured non-performing asset. But of course, this 199% will make it look like, oh, it's very safe, right? However, we need to know that all these coverage ratios, they are retrospective. It doesn't take into account what might happen in the future as more and more assets turn non-performing.
Sure. It could be a domino effect as well, even for the secured side.
Correct.
If everyone defaults on their houses, then prices will come down and your secured value should come down, right?
Yes, that is possible as well.
Yeah.
Yep. So there is also a possibility of uplifting of allowances in good times. So we see that if you take a look at DBS, they have a portion. For example, we take a look at the last column, first half of 2020. They added some charges for new NPL and existing NPL increased amount, and then they actually subtracted charges for upgrade, settlement, and recovery. okay, there was no upgrade in the quarter. So for example, if suddenly this loan went into default and you are able to collect the collateral during the quarter, you are able to whatever salvage value that you have, you can actually charge it to settlement or recoveries.
Mm.
So that's how they actually can have a. Sometimes you see the allowances become a negative number. I think that happened for DBS. I think maybe 1 year back. Yeah, it was actually a negative number.
Uh,
Yeah. So this is possible, and yeah, that is that's so it's not all gloom and doom lah. If a bank over provide, there is hopes that when things turn well, they can charge it back and they'll go back into their equity.
sure. So it's almost like if you impair, I mean, I guess if in a normal accounting methodology, if you impair something and the impairment is not as bad, you kind of add it back as a profit to your P&L.
Kind of like a revaluation, yes.
Yeah, revaluation. Yeah.
Okay, so let's move on to something more interesting. So what I've been through is just like going through like the income statement. So
Yeah.
let us move more into the Singapore banking industry itself. Like, what is the outlook of these Singapore banks, right? So we try to take a look at it again against the metrics that we were talking about. First of all, we look at the revenue numbers. Revenue numbers, we know that we are hit by low interest rates, and we are also hit by low loans growth in Singapore. Generally, the economy is just quite subdued right now, and this will
Mm.
be a very strong headwind for the net interest income. So in the short term, of course, there will be some recovery because during the circuit breaker lockdown, it was like a switch turning off, right? So now that you turn back on, of course, there will be a stream upwards. But when we want to compare it to a pre-COVID-19 healthy economy scenario, it is
Yeah.
unlikely to reach back to such levels in the near term. It'll probably take at least 1 to 1.5 years more
Yeah.
net interest income wise, especially when the Fed already came out and say like, just forget about a rising interest rate for raising interest rates over the next 2 3 years. Yeah.
Sure.
Then, when we look at the poor but recovering economic conditions, we have a very uncertain non-interest income. So there are like capital market activities, for example, merger and acquisitions. Of course, you see some companies trying to undertake some merger and acquisition now that some valuations are looking quite attractive. However, a lot of companies are still in the energy saving mode. So they are trying to save their capital to see whether they can tide over this period properly before undertaking any merger and acquisitions yeah. But for wealth management, it really depends. I think Singaporeans generally seems to have quite a good healthy savings habits. So we do expect to see some wealth management fees recover lah, especially during the now that people can meet face to face and have bookings to talk about your bank assurance and your insurance products.
Right. Right. Right.
And in terms of expenses, we do see that the cost to income ratio, it has been increasing. So that's a bad thing. It kind of deteriorated. Previously, some of the banks were quite close to hitting 40%, but now that because the income fell by so much, their cost to income ratio kind of increased, moved in the other way. And we do see like for UOB, they already came out and say that they're going to freeze their wages, which kind of signal their cost control measures lah. So we are not expecting them to suddenly come out and say, oh, we are going to cost cut by this amount that will help us to buffer our earnings. Because ultimately, in the Singapore economy, a lot of what the government is saying that is to the employers is that to try to keep them employed. We don't want our employment rate to increase by so much. Rather, you keep them employed, and even if there's no pay raise, it's okay. Yeah. Then lastly, we talk about the credit outlook. So like Alvin was mentioning previously for the loan moratorium. So we know Malaysian actually just exited your loan moratorium. So actually this is a very big hurdle for some of the Singapore banks that have exposure in Malaysia. So I think UOB, they were quite concerned with how it will exit, because if it exits and suddenly everybody just come out and say, oh, I'm not going to pay for my loans anymore, then that's when the credit cost will start to rise by a lot. And because I think for Malaysia, it is based on an opt-out basis. So by default, you're opted into this loan moratorium. You do not need to pay your interest. So that is something. So a larger portion of loans in Malaysia for Singapore banks itself are actually held under loan moratorium, right? Whereas for Singapore wise, ours is on a opt-in basis. If you need it, then you go to a bank and tell them that you need to defer your interest payments. So in terms of
How long is the what's the maximum tenure for the moratorium in Singapore?
okay, so previously it was up till end of the year,
Okay.
and right now I think just 1 or 2 days, 1 day ago, yeah. So 1 day ago they kind of extended it for the more vulnerable segments.
Oh, okay.
Yeah.
So it's until
So
end of year and potentially could be longer if you opt
yeah, I
in.
think some of them are extended till March next year.
Okay. Wow.
Yeah, so it is a kind of like a worrying sign, because in what investors like is we like transparency. We like the banks to tell us, oh, this is fine, this is not fine, and then we can just, all the information come in overload, and we are okay, that's fine. We take
Yeah.
into account all of that. But when you have uncertainty, and then you push back this uncertainty by a certain time period, it makes it even harder for investors to like be convinced that, oh yeah, things is gonna turn out fine. Yeah.
Right.
Yeah, and especially when the banks have already guided for heightened allowances over the next few years, over the next 2 years, we are and with this moratorium extending, we are kind of unlikely to see them cut back on providing the additional allowances in the short term, lah. So generally, a lot of analysts, what we think is, actually once the loan moratorium ends, we are by the end of the year, at least for financial year 2021, we can have a better indication of how well the banks are going to recover. But right now, with all these extensions, yeah, it's just pushing back the deadline. Yeah, so that's not very good. Yep. So next slide. This is just I know this will look a bit confusing for most of us. But what I did was I actually take into account how the loan book that the three banks have. So you can see for the first line, DBS has about $380 billion in loans. OCBC has about 270 billion, and UOB has about 280 billion. And the respective guidance in terms of credit costs for the three banks. So we see more. It is roughly between 100 to 120 basis points, but DBS kind of gave a wider guidance. They gave 80 to 130 basis points over 2 years. So if you divided it by two, if you want to count it, what's the credit cost for 1 year, right? And I calculated based on their gross loan book amount, how much allowances are they expected to take up in the over the 2 years. So we see that it ranges between 2.8, 2.7 billion to up to 5 billion for DBS because they have a larger loan book. Then I just did a comparison between what their reserves currently were before COVID-19, so financial year 2019 at the levels, and their current levels as of end June. So if you move towards the lower end, the total reserves part, second last line, you see that total reserves for across the three banks actually increased kind of in tandem. So DBS increased by about $1.3 billion, and OCBC went up by 1 billion, while UOB went up by 700 million. So a lot of people were quite curious because UOB's one seems to be much lesser, and it's not in because their loan book, OCBC and UOB's loan book is about the same, but then their total reserves kind of didn't go up as much as OCBC. So a lot of people were afraid that, you know what, maybe UOB might need to cater for more allowances in the future, right? But if
Yeah.
you move up two lines and you see that the part of it that was catered as a result of general provision is because it's roughly the same. So for UOB, they actually went up by 670 out of their $700 million dedicated in allowances this year. $670 million were a result of an increase in GP, which is a general, right? So it is not tagged to a particular bad loan account. Whereas out of the $1 billion that OCBC increased in reserves, only 600 million is attributed to GP. So that means their Hin Leong exposure is roughly 300 plus, makes up the remaining 300 plus million dollar that you see right here. So in terms of runway, what we see is that generally across the three banks, they are kind of on track. So we compare it to the guidance based on half a year. So that's 25% of the runway till the end of 2021. Among their, based on their guidance, they have provided about between 20% to about 45% of total allowances that they actually need to cover. So generally,
So
we
worst
feel
case scenario, probably say very badly, maybe 50% of your reserves would be at worst written off.
Yeah.
Yeah.
So yeah, that's what we are. So at least the fact that currently, because they are still profitable, they are able to cut off some of their profits and put them into their reserves right now, so that when it actually happens in the future, it might not be that bad.
Sure.
So now I want to just point out some differences across the three local banks, so that it helps like viewers, if you're really thinking about investing into the Singapore banks, what might you look out for, right? So for DBS itself, it is the largest bank in Singapore, so they have the highest CASA ratio. So basically, we know that CASA ratio is the lowest cost of funding. So in terms of against the net interest income pressure, they are kind of more exposed because you can't reduce the interest rates on your normal savings accounts anymore. It's already near zero. You can't go negative. It is quite unlikely that they will ever go negative. So this is something that is not that good, because in a good time during high interest rates environment, that will be great because they can keep it low. But in an environment whereby it's low interest rates already, you can't cut anymore. So that's the pros and cons of having a high CASA ratio. And for DBS itself, they have a very good investment banking franchise. So if capital markets activity were to resume, we do see that DBS will stand to benefit the most out of the three banks. Yep. And secondly, OCBC, we do see heightened provisions because generally their exposure to the oil and gas market is just much larger. And across the past few quarters, what we have been seeing is that the specific provisions coming out of this oil and gas exposure has been quite high. So that is something to take note of. And they do have a leg in the Great Eastern insurance business again. And because Great Eastern generally, they take the insurance money and then they invest into funds, right? So if there is more volatility of on the earnings when the market fluctuates, when the prices of the investment securities actually move, so that is something that they might hit by. Of course, in a good time they'll recover fast, and in the bad time they'll be hit the hardest as well. Yeah. And for UOB, so like I was mentioning previously, for the specific provision side, is good over the first half of the year that they have seen very low specific provisions formation. So everything goes into their GP. So yeah, it's like quite healthy. And they do have a very much larger ASEAN exposure in the Southeast Asian, Indonesia, Thailand, Malaysia, these areas. So it really depends on how the economy kind of recovers as in the ASEAN region compared to the Asia region, whereby OCBC and DBS have higher exposure to. So DBS and OCBC, they are slightly more China-centric, Hong Kong-centric. Yeah, whereas UOB is more ASEAN, going for the middle income kind of middle wealthy income kind of bracket in terms. Yeah.
See.
So yeah, I think that's about all I have. Yeah. I'm
Okay,
actually ready
great.
to take some questions. Yeah.
So thanks for that. That was I guess if you had zero knowledge about banking, then that would be a good starter, right, for some of you guys here. So I have a few questions here. Let me kind of just flash it on your screen and then we can kind of discuss it. So I've got a question here from Peter Law. He's saying expected credit loss. Does that, or maybe a better kind of explanation on ECL? He's saying that does it include non-performing loan provision that cannot be recovered?
Okay, so for non non-performing loans, so you actually you need to write it off your books first. And if they actually become healthy again, suddenly they decide that, oh, I can pay off my loans. I want to pay off my loans so that maybe in the future I can do more business with the bank. They can actually write it back. So it's not a case of I cannot recover anymore. But of course, it will, on the bank side, they will pretend that it is never there anymore, and they took it as a loss. Yeah.
Right. So ECL is basically a general provision, right, into what you're expecting to lose. But can I say that banks may get it wrong about maybe over provisioning or under provisioning
Of
into the
course,
ECL?
there is there's a high probability, but because they are the ones holding the model, we do not know what goes into the model, especially for the GP side. Uh,
Mm,
we can't tell, say like, and even across the three banks or across all the banks, your own ECL model differs from one another.
right,
So
right.
it is not like an industry standard whereby everybody maintains the same model. Yeah, so they can actually cater for their own factors that are affecting it.
So it's like a little black box that we don't know what goes inside, right?
Yes,
Okay.
unfortunately.
Okay. All right. So this is from Darren here. What is the percentage of tier one or tier two capital ratio? I guess in this case, Singapore banks, right? Well, what is that percentage?
Right. Okay. So I didn't really talk about the capital ratio. I think it might be quite confusing. I also recently just managed to understand it a little bit more. So what happens is generally it basically is the level of capital that you need to maintain at the bank level, right? In case any you need to use your capital for loans and etc. Uh,
Yeah.
Under regulation, you do have a common equity tier one and tier two ratio. If I'm not wrong, as of right now, the regulation has need to take into account you need to have at least 10.5% for your capital tier one and 12.5 for tier one and 14.5 or 16.5 for tier two total. So kind of like a total. So it's an incremental. So it's all your equity CET1 will be considered for tier one, and all your CET1 and tier one will be considered for tier two. Yeah.
Ah,
And yeah, but it is a very iffy kind of number. It changes, it can change, and it cannot just look at it in isolation. I can have a very high CET1 ratio, but because your CET1 ratio is a function of risk-weighted assets as well as uh, your earnings. So for example, if your risk-weighted assets, if the risk increase and then your there's a credit migration from your loans. So for example, suddenly your non-performing loans increase by a lot, your CET1 rate, your capital ratio might drop drastically. Yeah. So and it's a very retrospective kind of metric right now. So what we are looking at for the local banks, CET1 level currently is hovering around 13.5 to 14% for CET1 ratio. Then what we are assuming, oh, is much higher than the 10.5%, right? But we are not taking into account what are the future possible bad debts that might arise that will cause some credit migration that might push the ratio down by a lot. Yeah.
okay. 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 So I guess this was answered earlier, and I guess we had a chat about it about Hin Leong. Let me kind of see. There are kind of interesting ones. So I've got one from Hee Kyung Lim. Across the three banks, has anyone stopped dividend payments?
Okay. So I'm not sure about Malaysia for Malaysian banks, but for Singapore banks, there were no guidance to stop dividends, but we do have a regulation. The MAS actually came out and say, you know what, we would need the banks to actually cap your dividends at 60% of the 2019 levels. So it is a 40% dividend cut in a sense. And previously, it was very attractive for investors because the banks were trading at like a dividend yield of between 5 to 6%. And now with the cut, it's currently about 3 to 4%. Yeah.
But I mean,
And
but it's quite interesting. I mean, I guess in the long run, if you put money in the bank in a fixed deposit versus buying a banking stock, you would still make more money buying a banking stock, right?
Yeah, it does seem that way. Yeah.
Almost does not make sense, right? But anyway.
Yeah. And by the way, also for the Singapore banking, the regulations for the dividends itself, they are also required to allow investors to reinvest your dividends as shares.
Mm,
Yeah. So the amount of dividends that you're receiving, you can choose that and say, I don't want to receive it in cash. Let me get the shares instead. But what we do see is that the banks are just pegging it to usually when the banks offer share dividend, they try kind of offer it at a discount so that to entice investors to choose the shares, right?
yeah,
However, this time round, for DBS and UOB, they kind of peg it to market price. So there is no incentive for you to actually choose shares dividend, but it does send the signal across that they don't need to save their capital, because if you actually cut your dividends, you actually save the cash on hand, right? So
yeah,
your capital ratio actually increases because
yeah.
your numerator increases.
Right, right. So it means the banks are quite confident they are okay in terms of capital
Yes,
adequacy.
correct.
Okay. Um, okay, this is quite interesting one. This is from Terence here. So Phillip Securities, right? Is there a house call for any of these three banks? Are they a buy, hold, or sell?
Okay, so at Phillip, I'm the person covering the banks. Um,
Yeah.
I cover the banking sector and the healthcare sector. And for the banks itself, we do have coverage on all three of them. And all of them currently are at a accumulate call. So our rating is across five classes. We have buy, which is in returns of excess of 20% in the next 1 year that we expect. For accumulate is between 5 to 20%. And for neutral, we have between -5 to 5%. And then we have reduce, which is the flip side of accumulate, -5 to -15%, and then -20%, and then we have a sell call. So it's across five, and it
Mm,
is rated at 2, so it's an accumulate call lah. But we count it by total return, so we of course we include the expected dividend yield as well.
right, right. So which means all three banks are in accumulate call now?
Yes, what we do notice is that actually in Singapore, the three banks are very largely correlated. Basically, they move in tandem with one another. So
Uh,
it is quite hard to um, if to choose between the three banks. So that's just now the pointers that I mentioned. Um, the 3 points that I mentioned about the differences between the three banks, it is a very small differentiation between the three banks, I would say. But generally, they move in tandem, and DBS tends to be more volatile. Yeah, in terms of the prices.
DBS 10. Okay, all right. So basically, I mean, if you guys are curious, all three banks year to date are all negative. So for value investors out there, you might be very happy. All right. Okay. Um, okay. Let me see. Now, do you have? I mean, just now we were talking about over providing and under providing. How accurate is general provisions, right? GP, right? Um, I mean, I guess you've been covering banks. Would you say one bank is typically always more conservative than the other
Okay,
amongst the three?
hmm, so when we take a look at the difference between preemptive and reactive, right, kind of style, um,
Yeah.
we do see that generally UOB has been more conservative,
Mm,
yeah, in terms of provision. But in terms of the financial power, DBS has a very strong like runway for them to just suddenly say, oh, you know what? Let me just take a huge chunk of it into my, so they can just turn the thing around very fast. So that's what we saw in the first quarter. They just suddenly decided that, oh no, I'm just gonna take like 30-40% into allowances and just chuck it one side, so I don't have to think about it, the worry about it near term. Yeah.
mm. And also, I guess it helps if the Singapore government, the government owns you, right, and almost gives you the power of unlimited money, right?
I guess that's partially true lah. But of course, I mean, the Singapore generally is more of working hand in hand with the regulators and understanding what the MAS regulators want for the economy. So they are like a spokesman for the industry, for the economy as well, to
Right,
lend
right.
them support. Yeah.
So definitely too big to fail, lah.
Uh, that one I can't say.
It's okay, it's okay. Okay, so I've got one question here from Lei Tan here. What is the proportion of borrowers that took up the moratorium from, for the three Singapore banks for second quarter? Was it a big percentage?
Yes, if I think if you were to compare it to the Singapore loan book itself, it ranges between I think 10 to 15% of their loan book that is under moratorium right now.
Mm,
And it's mainly split between I think um, SMEs and housing loans. Yeah.
mm,
So generally, um, I would say okay. Oh yeah, and the thing is that for housing loans, when Singapore cater for housing loan moratorium, you do not need to pay. You can defer both the interest and the principal,
principal.
right? But for uh, corporate loans, you can only defer the principal. You can't defer the interest.
Ah, right. Okay, okay. Yeah, I think same thing here. We deferred everything, right? Because it was an opt out option, right? Yeah. Okay. Okay. So I mean, you talked about how confident. I mean, the banks have signaled they are quite confident. When you talk about your dividend reinvestment plans, now being at market prices, I guess I think it's kind of open secret. Everyone's expecting a high write off for banks, right? Um, how badly do you think this is going to affect dividends going forward?
Right. So of course we know that dividends will be cut by at least 40% over the until at least financial year 2021.
Yeah.
So moving forward, of course, they are at the whim of the regulators. If the regulators come and tell them to continue cutting, they have no choice but to cut.
Yeah.
But first cut without barring any unforeseen circumstances, we are expecting the banks to at least return to their pre-COVID-19 dividend levels. Yeah,
Mm,
because I think at the pre-COVID-19 dividend levels and their earnings, if they were going hand in hand, they will still be able to build up their capital ratio. So the
mm,
first step is definitely post COVID-19, they will want to build up their capital ratios back to a healthy 13.5 to 14% level. And once they have done that, if they have excess capital on hand, then we might see some of the dividends that got cut off might have a chance to see
repaid.
correct. Hopefully, that's something that a lot of investors want.
But I guess so. If you're investing, you're really essentially investing for when things kind of go back to normal, which is we're expecting 2022. At least a 2 3 year horizon, right?
Correct.
Okay. Okay. Uh, so this is from Darren here. DBS is owned by government, and OCBC and UOB are family businesses. So in the long run, which bank do you think will perform better, or are there very specific? Apart from what you have mentioned, are there any strengths or weaknesses between them?
Okay, I think DBS generally, I'm not sure whether it is because of who they were owned by, lah, but in terms of the banks, generally DBS seems to have a stronger leg in the digital game. So we know that digital banking is like the next up and coming thing. They have moved the earliest in response to the digital banking license that is coming out in Singapore. They have put in more investments in this area. Yeah, so it does seem like they are like showing their strength during this period of time lah, that we can weather this, we are big enough to weather this without any repercussions. Whereas I think on the side of OCBC and UOB, because they're family owned, they tend to be more conservative in terms of the guidance. Yeah, they just want to taper the expectations rather than to say like, oh, we are fine, because they don't want the bad side of things to happen, and they have not done enough.
So, I mean, I'm just curious. I mean, there are some questions here. What of the three banks in Singapore, which traditionally pre-COVID can have one of the lowest? Which are the ones that have the lowest NPL, non-performing loan?
Yeah, actually, across interestingly, across the three banks, the non-performing loans ratio has been about the same. It stays at about roughly 1.5%.
Oh, for all three banks, about the same.
Yeah, like 1.5, 1.6%. Now it's about 1.6%. It's just ticking up slightly, but it's still very low.
Yeah, because in Malaysia here, we only have one bank that's been consistently very low in NPL. The rest have been, quite miles ahead. So that's quite interesting. Yeah. Okay, I think maybe just one last question here. I'm not sure about this. Philip is asking, what's the contribution of the Bank of Singapore to OCBC's financial statement?
Wow, actually, yeah, I don't, they don't, because it is all together. They don't really segregate it out. We can't really tell, but generally for Bank of Singapore side, they are engaged in more corporate finance business and more towards the high net worth business, wealth management. I'm presuming, so more fee rather than the income side, the net interest income side. Yeah, but in terms of proportion, they don't really disclose.
Okay. Okay, look, I think we're closing up at almost 1.5 hours. I thank all of you guys here for the comments. Mr. Tay, thank you very much for spending the evening with us and explaining to us about the banking industry. Again, for all the viewers out there, if you can just comment and say thank you to our guests from Phillip Securities. Wee Kuang here, who was here with us for 1.5 hours. You can actually download his slides. Just make sure you send us a WhatsApp at 603-8408-2070. Just select Singapore Tuesday, and you can download the figures. All right, you can download his slides that he's put up. All right. I think we'll kind of close up for today. Thank you very much again, Wee Kuang, for joining us and spending the evening with us.
No problem. Hope you guys enjoy yourself, and feel free to contact me. My email is in the slides, so yeah, can feel free to ask me any questions.
Be very careful when you do that, because you're gonna have 300 people sending you emails tomorrow. All right. Okay. For those of you guys who are not aware, first time joining us, we actually have a Facebook group. If you're going to check out ET Online Campus SGX, this is really where you can post any questions about the SGX market for discussion, right? It's free to join. All you do is just look for ET Online Campus SGX, Singapore Stock Exchange, and you can go and check it out. If you haven't yet joined it, just do a search. It's already on Facebook as well. All right. Tomorrow we'll be back with our Mandarin session, and on Thursday, Andrew will also be back with Future Proof, which is anything future related or tech related. All right. If that's all for now, thank you very much, everyone, for joining us. We'll see you guys again tomorrow. Good night. Bye-bye.
Bye.
Thanks, Vikas. Bye.